All right, so let's dive into the world of stocks. And whether you're, getting ready for a meeting or catching up on finance or just, kind of curious about how stocks work, we've got you covered. We're going to be exploring, what it means to actually invest in stocks, the different types that are out there, and the strategies that you can use to make your money work for you. For example, did you know that some stocks actually pay you just for owning them? They're called dividend stocks, and they give you like a share of the company's profits regularly. It's like getting a bonus just for being a part owner. But on the other hand, if you're feeling a bit more adventurous and you're aiming for those sky-high returns, you might be interested in something called growth stocks. And these are companies that are expected to grow really fast, but they also come with more risk. Intrigued? Let's unpack this with our experts. So,
Yeah, so you know what's fascinating about the stock market is that it offers so many different options for investors. It's not a one-size-fits-all situation. So let's start with the basics. Common and preferred stocks. Think of common stocks as like the standard entry ticket to a company. You get voting rights, which means you have a say in how the company is run, and you might receive dividends if the company is doing well.
so it's like being a member of a club,
Boop, boop, boop.
having a voice and potentially getting some perks along the way.
Exactly. Now, preferred stocks are a bit different. They're like having a VIP membership. Preferred stockholders have a higher claim on the company's assets and dividends, meaning they get paid first if the company goes belly up or decides to distribute profits. However, they often have less or no voting rights.
Interesting. So it's a trade-off between having a voice and potentially getting a bigger slice of the pie. It all depends on what you prioritize as an investor.
Absolutely. Now let's move beyond the basics and consider how companies grow and how that affects your investment. We can categorize stocks as either growth stocks or value stocks. Growth stocks are companies that are expected to grow at a much faster rate than the average company. Think of them as the rising stars of the market, with lots of potential, but also more risk.
Okay, so these are the companies that people are hoping will become the next Amazon or Tesla, right?
Precisely. Investors are betting on their future success. But it's important to remember that high growth potential often comes with higher volatility. Their stock prices can swing wildly, making them a bit of a roller coaster ride.
So you need a strong stomach and a long-term perspective if you're going to invest in growth stocks. What about value stocks? Those sound a bit more my speed.
Value stocks are like finding hidden treasures. They are companies that are currently undervalued by the market for various reasons. They might be solid companies with a good track record, but for some reason the market isn't giving them the credit they deserve.
So it's like finding a designer handbag at a thrift store.
Exactly. The trick is to spot these undervalued companies before the market realizes their true worth. And to do that, you need to understand how to analyze a company's financials and assess its intrinsic value.
Sounds like there's some detective work involved.
Yeah.
But before we get into that, can we talk about the practical steps of actually buying stocks? I mean, where do you even begin?
That's a great question. The first step is to open a brokerage account. Think of it as your gateway to the stock market. You can open one online with companies like Robinhood or TD Ameritrade, or you can go with a traditional financial institution.
Okay, so once you have a brokerage account, what's next?
Then comes the fun part, research. You need to choose which stocks to invest in. This is where things can get a bit overwhelming, especially for beginners. There's a ton of information out there, and it can be hard to know where to start.
I can imagine it's like trying to drink from a fire hose.
Exactly. But there are resources available to help you. You can use online tools and platforms to screen for stocks, read analyst reports, or even consult with a financial advisor.
So it's all about gathering information and trying to make sense of it all. Are there specific things you should be looking for when you're researching a company?
Absolutely. You want to understand the company's financials, their growth prospects, their management team, and their competitive landscape. You can use fundamental analysis, which involves looking at the company's balance sheets, income statements, and cash flow statements. This will give you a picture of the company's financial health and its ability to generate profits.
Okay, so that's fundamental analysis. Is there another way to analyze stocks? I've heard people talk about something called technical analysis. What's that all about?
Technical analysis is a different approach. It focuses on studying price charts and trading volumes to identify patterns and trends that might predict future price movements.
So it's like trying to read the tea leaves of the stock market,
Well,
looking for clues in the charts.
In a way, yes, but keep in mind that technical analysis is more about predicting short-term price movements, whereas fundamental analysis is about assessing a company's long-term value.
Okay, so two different approaches, each with its own strengths and limitations.
Interesting. So once you've done your research and you've decided which stocks to invest in, how do you actually buy them?
You place an order through your brokerage account. It's really quite simple. You specify the stock you want to buy, the number of shares, and the price you're willing to pay.
So it's like online shopping, but instead of adding shoes to your cart, you're adding shares of Apple or Google.
Exactly. And just like with online shopping, you can track your orders, monitor your portfolio, and even set up alerts to notify you of price changes or other important events.
So it's all very user-friendly these days. But even with all these tools and resources, I imagine investing can still be quite intimidating, especially for someone just starting out.
It definitely can be. But don't let that discourage you. The key is to start small, learn as you go, and remember that investing is a marathon, not a sprint. You don't have to become a stock market guru overnight. That's reassuring to hear. So we've covered the different types of stocks and the basics of getting started. Now, I'm curious about the different ways you can actually approach investing. I've heard people talk about things like long-term investing and dividend investing. Can you shed some light on these different strategies?
Absolutely. Let's dive into the world of investment strategies. And there are many, but let's start with a classic, long-term investing. This approach is all about choosing stocks that you believe in for the long haul and holding on to them for years, even decades, to benefit from their long-term growth.
So it's like planting a tree and letting it grow over time, knowing that you'll eventually reap the rewards of your patience.
Exactly. The key to long-term investing is to choose companies that have a strong track record, a solid management team, and a sustainable competitive advantage. You're looking for businesses that can weather economic storms and continue to grow over the long term.
So it's not just about picking the hottest stock of the moment. It's about finding companies that are built to last.
Precisely. And one of the most famous advocates for this approach is Warren Buffett, often considered one of the greatest investors of all time. He's known for his long-term perspective and his focus on companies with a wide moat, a term he uses to describe a company's ability to protect its profits from competitors.
Okay, so if you're going to follow in the footsteps of Warren Buffett, long-term investing might be the way to go. But let's say you're looking for a more immediate return on your investment. That's where dividend investing comes in, right?
That's right. Dividend investing is a strategy that focuses on companies that regularly pay out a portion of their profits to shareholders in the form of dividends. These companies tend to be more established and have a history of consistent earnings.
So it's like getting a little bonus check every quarter just for owning the stock.
Exactly. And what's even better is that you can choose to reinvest those dividends to buy more shares of the company, which will then generate even more dividends in the future. It's a powerful way to grow your wealth over time.
Okay, so it's like a snowball effect. The more dividends you reinvest, the larger your investment becomes and the more dividends you receive. I like the sound of that. But how do you know which companies are good dividend payers?
When evaluating dividend stocks, you'll want to look at a few key metrics. One is the dividend yield, which is the annual dividend payment divided by the stock price. This tells you what percentage return you're getting from the dividend. Another important factor is the payout ratio, which is the percentage of earnings that the company pays out in dividends.
So you want to make sure the company is actually earning enough money to sustain those dividend payments.
Exactly. A high payout ratio might be a red flag, as it could indicate that the company is stretching itself too thin to keep up with those dividends. Ideally, you want to find companies with a sustainable payout ratio and a history of consistent dividend increases. This shows that the company is committed to rewarding its shareholders and that it has the financial strength to continue doing so.
That makes sense. So we've covered long-term investing and dividend investing. Now, what about investors who are a bit more risk-averse and want to spread their investments across a broader range of companies?
That's where index funds come in. Index funds are a type of mutual fund or exchange-traded fund, ETF, that tracks a specific market index, like the S&P 500 or the NASDAQ 100.
So instead of picking individual stocks, you're essentially buying a basket of stocks that represents a particular segment of the market.
Exactly. Index funds offer a convenient and cost-effective way to diversify your portfolio across hundreds or even thousands of companies. This helps to reduce your risk because if one company in the index performs poorly, its impact on your overall portfolio will be minimal.
That's a great point. Diversification is key to mitigating risk.
Hmm.
But what about dollar cost averaging? How does that strategy fit into the mix?
Dollar cost averaging, or DCA, is a simple yet effective strategy that involves investing a fixed amount of money at regular intervals regardless of the market's ups and downs.
So you're basically ignoring the daily fluctuations of the market and just sticking to a consistent investment schedule.
Precisely. The beauty of DCA is that it takes the emotion out of investing. By investing consistently, you'll automatically buy more shares when prices are low and fewer shares when prices are high, which helps to average out your cost basis over time.
That sounds like a smart way to avoid the common pitfalls of emotional investing.
It is. DCA can be a particularly useful strategy for long-term investors who are regularly contributing to their investment accounts. It helps to smooth out the ride and reduces the risk of buying at the top of the market.
Now let's shift gears a bit and talk about a strategy that requires a bit more research and analysis: value investing. We touched on this earlier, but can you dive a little deeper into what it takes to be a successful value investor?
Value investing is all about finding undervalued companies and buying their stocks at a discount to their intrinsic worth. It's a strategy made famous by investors like Benjamin Graham and his student Warren Buffett.
So it's like bargain hunting in the stock market, looking for hidden gems that everyone else has overlooked.
Exactly. Value investors believe that the market sometimes misprices stocks, creating opportunities for savvy investors to buy low and sell high. But to be a successful value investor, you need to be able to distinguish between a genuinely undervalued company and a company that's simply cheap for a reason.
That sounds like a tricky distinction.
Yeah.
How do you go about assessing a company's true value?
Value investors use a variety of tools and techniques to evaluate a company's intrinsic worth. They might look at the company's financial statements, its assets, its earnings, its debt levels, and its management team to determine whether the stock price accurately reflects the company's underlying value.
So it's like doing a deep dive into the company's financials, looking for clues that the market might be missing.
Exactly. And it's not just about crunching numbers, it's also about understanding the company's business model, its competitive landscape, and its future prospects. Value investors are looking for companies that have a solid foundation and a clear path to future growth.
Okay, so value investing is all about finding those diamonds in the rough. Now, what about investors who are more interested in betting on the future and investing in companies that are poised for rapid growth?
That's where growth investing comes into play. Growth investors focus on companies that are expected to grow at a much faster rate than the overall market. They're looking for companies that are innovative, disruptive, and have the potential to become the next big thing.
So we're talking about companies like Tesla or Zoom companies that are revolutionizing their industries and capturing a growing share of the market.
Exactly. Growth companies tend to be younger, more volatile, and less likely to pay dividends. They're reinvesting their profits back into the business to fuel further growth. So investors are betting on their future potential rather than their current earnings.
Sounds like growth investing comes with a higher degree of risk, but also the potential for much higher returns.
That's right. Growth stocks can be a roller coaster ride with sharp upswings and downswings. But for investors who are willing to take on more risk and have a longer time horizon, growth investing can be an exciting and potentially very rewarding strategy.
Now, I know some investors prefer to focus their attention on specific industries or sectors that they believe are poised for growth. What's the thinking behind this approach?
Sector-specific investing is all about identifying industries or sectors that you believe will outperform the broader market.
So it's like placing your bets on the sectors you think are going to win the race.
Exactly. Investors might focus on sectors like technology, healthcare, renewable energy, or even specific subsectors within these industries. For example, if you believe that artificial intelligence is going to be the next big wave of innovation, you might invest in companies that are developing AI technologies.
Okay, so it's all about identifying trends and riding the wave of innovation. But wouldn't this approach make your portfolio less diversified?
It can, which is why it's important to carefully consider the risks and rewards of sector-specific investing. If you're going to concentrate your investments in a particular sector, it's crucial to do your research and understand the industry dynamics, the competitive landscape, and the potential risks involved.
So you need to have a deep understanding of the sector and the companies within it.
Precisely. You also need to be aware of the cyclical nature of many industries. Some sectors go through periods of boom and bust, so it's important to be mindful of the timing of your investments. But for investors who have a deep knowledge of a particular sector and believe in its long-term growth, potential sector-specific investing can be a way to enhance their returns.
That makes sense. So we've covered a wide range of investment strategies, from the conservative and steady to the more adventurous and growth-oriented.
And it's important to remember that there's no one-size-fits-all approach to investing. The best strategy for you will depend on your individual circumstances, your risk tolerance, your investment goals, and your time horizon.
So it's about finding the right mix of strategies that align with your personal financial philosophy.
Exactly. And it's also about being flexible and adapting your strategy as your circumstances change.
Yeah, it's like building a personalized investment portfolio that reflects, your unique goals and risk appetite. But before we wrap up, let's talk about the potential rewards and risks of investing in stocks. Um, what are some of the advantages that might entice someone to, dip their toes into the stock market?
Well, one of the most appealing aspects of stock investing is the potential for high returns. Historically, the stock market has delivered an average annual return of around 7% to 10%, which is significantly higher than other asset classes like bonds or savings accounts.
Okay, so the potential for growth is definitely there. But what about liquidity? How easy is it to actually access your money if you need it?
Stocks are generally very liquid, meaning you can easily buy or sell them on stock exchanges. This gives you flexibility and control over your investments. If you need to access your cash quickly, you can typically sell your stocks and have the funds available within a few business days.
That's reassuring to know. It's not like locking your money away in a long-term investment that you can't touch. But we've talked a lot about growth and potential returns. What about income? Can stocks provide a steady stream of income for investors?
Absolutely. Many companies pay dividends to their shareholders. These dividends can provide a regular income stream, which can be particularly appealing to retirees or those seeking passive income.
So it's like getting a little paycheck from your investments. That's a nice perk.
Yeah.
And I guess another advantage of owning stocks is that you're actually becoming a part owner of the company, right?
You got it. When you buy a share of stock, you're essentially buying a small piece of ownership in that company. You share in its successes and potentially benefit from its growth and earnings. You're not just a passive observer, you're a stakeholder in the company's future.
That's a cool way to think about it. You're not just investing in a ticker symbol. You're investing in a real business with real products and services. But we can't talk about the rewards of investing without addressing the risks right. What are some of the things investors need to be aware of before they jump into the stock market?
Well, one of the biggest risks is market volatility. Stock prices can fluctuate significantly in the short term, sometimes for reasons that are difficult to predict or understand.
So buckle up for a potential roller coaster ride.
That's a good analogy. There will be ups and downs, and it's important to be prepared for that. Another risk is company-specific risk. If a company you've invested in performs poorly, its stock price could decline, and you could lose money.
That's a reminder to do your research and choose your investments wisely. You don't want to put all your eggs in one basket, so to speak.
Exactly. Diversification is key to mitigating risk. By spreading your investments across different companies, sectors, and asset classes, you can reduce the impact of any single investment's performance on your overall portfolio.
So don't put all your faith in one company, no matter how promising it might seem.
Precisely. And it's also important to remember that past performance is not necessarily indicative of future results. Just because a company has done well in the past doesn't guarantee that it will continue to do so in the future.
Okay, so don't get too caught up in the hype.
Right. It's important to look at the company's fundamentals, its management team, its competitive landscape, and its future prospects to make an informed investment decision.
This has been incredibly insightful. So as we wrap up this deep dive into stocks, what are some key takeaways that our listeners should keep in mind?
First and foremost, remember that knowledge is power. The more you understand about the stock market, the different types of investments, and the various strategies available, the better equipped you'll be to make sound investment decisions.
So do your research, folks. There's a wealth of information out there, both online and offline. Don't be afraid to ask questions and seek out advice from trusted sources.
Absolutely, and remember that investing is a journey, not a destination. It's about setting goals, developing a strategy, and making adjustments along the way. There will be ups and downs, but by staying focused and disciplined, you can increase your chances of achieving your financial goals.
Well said. And perhaps most importantly, remember that investing should be fun. Don't be afraid to explore different strategies, experiment with different investments, and learn from your experiences. The stock market is a fascinating world full of opportunities for those who are willing to take the time to learn and grow.
And as you embark on your own investment journey, I'd like to leave you with this final thought. The best investment you can make is in yourself. The more you learn, the more confident you'll become, and the more likely you are to succeed in the long run.
So keep learning, keep growing, and keep exploring the world of stocks. We'll be here to guide you along the way. Until next time, happy investing.